Welcome to the Deep Dive. We're here to cut through the noise, sift through the data, and really get to the core insights. Today, we're jumping into the Q1 FY26 results for Updater Services Ltd, or UDS. They're an Indian integrated business services platform. Our mission: to unpack their latest investor reports, the financials for the quarter ending June 30, 2025, and pull out what really matters for you.
Yeah, UDS is quite an interesting one. They're a major player, and what makes them stand out is this blend of integrated facility management, IFM, and business support services, BSS. And they have this massive footprint across India, serving over 4,000 customer locations. So they're really a comprehensive provider in a pretty diverse market.
Absolutely. And for you listening, seeing how a company like UDS handles its market, keeps growing, uses strategic moves, well, it can give you some really valuable insights into wider economic trends and, frankly, what makes a business model work.
Okay, let's unpack this then. Let's get straight into the headlines from Q1 FY26. So, starting with the top line, the revenue from operations. UDS reported just over 7,053 million rupees. Now, that's a 7% growth compared to the same quarter last year, Q1 FY25.
Right, and 7% might not sound earth-shattering initially, but considering the current environment, it suggests they're doing something right, either gaining market share or perhaps their service mix is proving quite resilient.
Good point. What about profitability?
Okay, so EBITDA came in at 444 million rupees. That gives them an EBITDA margin of 6.3%. But the figure that really caught my eye was the net profit after tax, the PAT. That jumped 13% year on year. It reached 290 million rupees, up from 256 million in Q1 last year. So they're definitely translating that revenue growth to the bottom line.
Okay, 13% growth in PAT. And earnings per share, EPS, followed suit. Exactly. Also up 13% year on year, landing at 4.4 rupees per share.
So consistent growth there. But here's where it gets really interesting, I think, the segment contributions. Where did this growth actually come from?
Yes, this breakdown is crucial. It really paints the picture. IFM, Integrated Facility Management, was clearly the powerhouse this quarter. It brought in 4,679 million rupees. That's 10% year-on-year growth for IFM, and it makes up 66%, two-thirds of their total revenue.
66%. Wow. So what about the other side, BSS?
Business Support Services, BSS, contributed 2,374 million rupees. But the growth there was much flatter, just 1% year-on-year. So BSS accounted for the remaining 34% of revenue. It definitely shows IFM was the main growth engine for UDS in Q1, provided a lot of stability.
Okay, IFM driving growth. Let's shift to operations then. What was happening on the ground to support these numbers? They mentioned adding 14 new logos, which is always good to see. And headcount grew pretty significantly too, right?
Yeah, up 9% year-on-year. They now have over 73,000 employees. That's quite a large workforce to manage and grow.
That really is.
Yeah.
And they onboarded some pretty big names too. For IFM, Bajaj Finance, Atlas, Omega Healthcare. And for BSS, TTK Healthcare, Ultratech, Reliance, even Amazon. And they expanded with Amazon in multiple states, I saw.
Yeah.
Karnataka, Adani Ports, and Cochin too.
Right. Those marquee client wins are important signals.
Right.
But digging deeper into the specific subsidiaries, you see a more nuanced picture. Take Denave, for example. They had some great wins. Palo Alto, Lenovo, SAP, big tech names. And they're pushing forward with tech themselves, investing in sales intelligence and agentic AI platforms. That's about boosting productivity, but it's also about future-proofing, using AI for demand generation.
Smart. And they won an award too.
They did. Malaysia's Best Employer Brands 2025. And they launched something called IntelliBank, so definitely active.
Okay, what about others? Like Athena?
Athena faced some headwinds. Revenue and profit took a bit of a hit because some clients brought operations back in-house. But their response is key. They're actively diversifying beyond just banking and finance, adding clients like Lota and Bajaj Electricals. And they're piloting an AI chatbot integration, trying to find efficiencies.
Makes sense. Adapting to changes. And Matrix, they do background checks, right? How did they fare with the IT slowdown?
Yeah, Matrix has definitely felt that IT hiring slowdown in its employee background check business. That was expected, I suppose. But on the flip side, their audit and assurance segment is actually scaling up. They landed Reliance Industries, Xiaomi, Unilever, Godrej Enterprises, and they're using tech platforms like Matex 2 to streamline things. So a bit of a mixed bag, but they're pivoting within the segment.
Interesting how they balance that. Any other subsidiary highlights?
Couple more quick ones. Global, which handles airport services, actually reported a positive PT. That's a turnaround from a loss last year. They're expecting more growth from new airlines at these Group D airports, smaller regional hubs, so expanding reach there.
Good turnaround story.
Fusion grew mostly as expected. Catering saw a slight seasonal dip, schools and colleges on vacation, but their margins still improved. And finally, Avon kept improving its margins too, helped by a better sales mix, more high-margin contracts. They've got plans for Q2 as well, launching PTL logistics, that's part truckload, and looking into corporate relocation, so always adding services.
It's quite a complex picture across all those subsidiaries, and it's worth remembering, as you said earlier, this is all happening against a backdrop of a, well, challenging macro environment.
Yeah.
Muted corporate spending, especially hitting BSS.
Exactly, which makes the overall performance, particularly the resilience of IFM, quite remarkable. They're driving margin improvements in IFM through scale and cost optimization efforts. It really shows the benefit of that large, stable base. We should also mention merger-related costs did slightly dent the EBITDA, but there was an upside. It helped with tax optimization, so a bit of give and take financially there.
Okay, let's talk financial health more broadly. Balance sheet strength.
Very strong. They continue to be a net cash company. Their net debt to equity ratio is actually negative, -0.2 as of June 30th. That's basically the same as it was in March. So excellent liquidity, very strong balance sheet, no concerns there.
That net cash position is definitely a plus. But I did notice one metric that went down, return on capital employed, ROCE. It was 22.1% in March, now 17.9% in June. What's happening there?
That's a sharp observation. Yeah, the ROCE did dip. It's not necessarily alarming on its own, though. Often after acquisitions, when you're integrating new assets, ROCE can temporarily decline before those assets fully contribute. Or it could be higher working capital needed to fuel that growth we discussed. Given their net cash, they have the flexibility.
So likely tied to recent investments or integration efforts rather than an efficiency problem?
That would be my interpretation for now, yes. It's something to watch, but likely reflects strategic capital deployment. We'd expect it to rebound as things mature.
Got it. So looking forward then, what are their main strategies for growth?
They've laid out a pretty clear multi-pronged approach. First, deepen ties with existing customers more cross-selling using tech. Second, grow market share in their key segments. Third, keep introducing new services. Fourth, continuously work on improving operating margins. And fifth, importantly, pursue inorganic growth strategic acquisitions, focusing on high-margin businesses.
That inorganic piece seems key given the recent mergers. And how does this fit with the wider industry? You mentioned IFM and BSS are growing markets in India.
Yes, the macro trends are favorable. The outsourced IFM market in India is expected to grow at a nearly 11% CAGR through 2029. A big driver is the shift away from doing facility management in-house towards outsourcing, and companies prefer organized, integrated players like UDF.
Makes sense. And BSS?
BSS is projected to grow even faster, actually, around 15.3% CAGR expected between FY23 and FY28. And UDS, with its incredibly wide range of services, is really well positioned to capture a good chunk of that growth.
So what is their core competitive advantage then? Being number 2 in IFM is big, but what else?
It's multifaceted. Their pan-India presence is a huge operational advantage. It lets them recruit, deploy, monitor, and shift resources very efficiently across the country. And then there's the sheer breadth of their service portfolio. Soft services, engineering, catering, mailroom, background checks, audit, sales support, airport ground handling. The list goes on. Being a one-stop shop is a major differentiator. It builds stickier client relationships and opens up loads of cross-selling opportunities that more specialized competitors just don't have.
And historically, they've executed well on growth, haven't they?
Absolutely. Just looking back at FY21 to FY25, their compound annual growth rates were impressive. Revenue up 23%, EBITDA up 29%, PAT up 26% annually over that period. It shows a strong track record.
Okay, let's quickly touch on some corporate housekeeping items. Audit and approvals, all clear.
Yep, all standard. The Q1 results were reviewed by the audit committee, approved by the board on August 5th, and they got an unqualified review report from their auditors, BSR & Co. LLP. Clean bill of health there.
Good. And the IPO proceeds from last year, have they put that money to work?
They certainly have. They raised about 3.78 billion rupees in the fresh issue during FY24. As of June 30th this year, almost all of it, 3.77 billion, has been used, primarily for repaying debt, funding working capital, and those inorganic growth moves. Only a tiny balance left for general corporate purposes, so quick and strategic deployment of that capital.
Shows discipline.
Yep.
And you mentioned mergers earlier impacting results.
Yes, that's important context. Stanworth Management and Tangy Supplies merged into UDS effective April 1st, 2024. That's why some prior period results had to be restated to show the combined entity. It reflects their active integration strategy. There was another merger too, Integrated Technical Staffing merging with Winwe Technologies from July 1st, but that didn't impact these specific Q1 consolidated results. It just further highlights their M&A activity.
Right. Busy quarter on the corporate action front, too.
Definitely. So wrapping it all up, UDS's Q1 really demonstrates, I think, a kind of strategic resilience. Their diversified model, especially with IFM providing that strong anchor, let them navigate a tricky environment and still post solid growth. It really underscores how blending organic growth, smart acquisitions, and operational focus builds a pretty robust business in the Indian services landscape. Almost anti-fragile, you could say.
A strong foundation, then, navigating challenge as well. So thinking ahead, what does all this mean? How might Updater Services Limited's integrated platform approach, this blend of organic and acquisitive growth, actually shape the wider business services sector in India, maybe even beyond in the years to come? And maybe for you listening, what specific innovations or market shifts do you think will be most critical for their continued success moving forward in such a dynamic space?